Alright folks, welcome back. This is a lecture on algorithmic theory for price action model number 3. And as you know, it's a swing trading model. And again, also, this is not to go through the entire trading plan, the components that make up this model that's already been taught to you. So I kind of want to give you the thought process and also go through what has recently transpired. We were on side, we were looking for the market to go this direction. And this is basically the swing trader's perspective on what it is that we were looking at and using this model. Now, the idea is to build it on the premise of the commitment of traders. You can also incorporate seasonal tendencies, but at the time of this recording, it's May 2022, and we have been bullish on dollar index. So obviously the respective counterparty to that would be bearish on foreign currency, i.e. the British pound. That's what we're seeing here. So this is pound versus US dollar. And this is a chart you can find on barchart.com using the interactive chart. And what I did was I used April, looked back 12 months, got the high and the low, respectively, midpoint, and you can see that we have had heavy selling by commercials, sent it lower, significant highs in the marketplace, and then we had this little bit of a build up here where it was rolling back up into a short-term premium. We broke lower, important high here. So again, not to reteach this whole commitment traders hedging program, but I break this COT data down like this, but just the commercial reading. We're looking at the trend. Okay, is it calling significant highs and lows? And we're focusing primarily on what direction is market likely to go. We've been bearish on foreign currency, bullish on dollar. So after we see a negative reading like this, we're expecting continuation lower. So we have everything indicating that this wants to go lower going into April. And let me go back up real quick here. You're gonna see this and say, well, look at this. This is going up. How can you use that? Again, it's the trend. Go back and listen to the teachings with the Commitment Traders hedging program. Okay, you can find that in the core content lessons. So if you look at what we've been doing here and go that route with the notes you've been taking with my commentaries, I've been calling these markets lower. I've been calling dollar higher. So when we're using this tool here, it's a intermediate term to long term approach. I don't trade intermediate term or long term. Okay, you have been taught how to do this. We've been looking for lower prices. I'm not going to sit down and try to do something that I'm not fit for with my personality. I have taught you how to do it. And this is, again, one more example of how this model works. I don't have the patience. It would require so much patience for me to hold a position this long. I just don't have it in me. So anyway, we're likely to see the rollover like this. And while it does that, the commercials will obviously be buying it back as it drops. So that's why you're seeing all of this running up here, okay? Which is normal. All right, so here's a British pound versus US dollar monthly chart. And obviously we're looking for lower prices. So the model says we look for a liquidity pool in the form of a single or relative equal low. In this case, we're looking for lower prices, so we can look for this low in here. Okay, we recently taken out this one here, so you could look at that also and do that as an additional study for yourself. But we're looking at this one here. Okay. So the sell side here is the draw on liquidity. We're likely to keep continuously going lower, higher on dollar. So we have our intermarket relationships there. And here is a zoomed in view of how the market, in fact, traded this month here, which is April of 2022. And again, the expectation is we want to see the expansion of that monthly candle reach for a liquidity pool. We're seeing that happen here. and we want to go into this and see how the model worked. Okay, the daily chart here, you can see we have the market retracing up into this price swing here, delivering below the old low, and digging down rather deeply in here. You can see the optimal trade entry from high to low. There's your optimal trade entry levels. So the market trades up into that, and then we would expect every subsequent day after that to try to work towards that old monthly low. And here's an objective down here. And we're going to drop down into the 4 hour. You can see the optimal trade entry here. Trades up into the imbalance here. Delivers, and this happens to be a Monday. Okay, so if you look at Monday's trading on this particular day in April, that's what this model is specifically aiming on, looking for shorting on a Monday, Tuesday, and or Wednesday, and looking for 100 to 300 pips of profit, because it's a swing trader's model. And you can see entering up here at 131, or just we'll call it 130.80. Okay, and we'll do that. So 130.80 to 126.80 before we can get to this level here. That is 400 points or 400 pips. So we have 100, 200, 300, 400, and then looking for a target. How far can we go below that low? Run your fib from here to here. Do your standard projections. And you'll get a standard deviation that lines up with this level here. Okay, that's your homework for this lecture here. So I want you to think about how simple this is. It's not a lot of moving parts. It's using the commentaries, the directional bias I'm pointing to, and then if this is your style of trading, if you can't go in and day trade, you can use this model here. Now you can use the lower time frame entry strategies. Once we enter into this area here, you can start using like the market structure shifts and then use a fair value gap to get into a lower time frame, like the model I've been teaching on YouTube, okay, which will be our model number 13. All kinds of ways to get into this move after it hits here, expecting it to go lower. Okay, there's so many ways it's been taught to you to enter the marketplace, and they're plug and play. You can use lower time frame strategies to get in after it hits this level here. And then once it starts to move lower, obviously you're holding for it to go down below here and resisting the temptation to collapse the trade entirely, because it gives you a little bit of retracement anywhere in here. Not that it did on this candle here, but this here, this is a classic return back up into an imbalance right before the delivery to that monthly low. And again, go back and consider what the dollar index was doing here. So everything fits together. It's not overwhelming. Okay, it's not a lot of things that you have to know and demand of yourself. But I gave you a trading plan with this approach. I've given you specific ideas to help you refine it. But once you understand what the market's likely to do, you can strip it down to just this right there. That's all it is. Knowing the bias, where's it likely to go? You're expecting that monthly range to expand. We're bearish, right? So we're expecting that monthly range or candle to go lower. We don't need it to close on its low. We just want it to trade lower. Offer up opportunity. That's what this is doing. From here to that old monthly low. You can get out just above it. Who says that's wrong? Nobody. You can get out at that very market low or below it. Or if you're overzealous and you want to get really gung-ho type of targeting under your belt, you can reach for objectives where there's standard deviations below it. But logically, you want to take something, just before the level, because it might not hit it, and obviously at or below it, take a partial there, and then see what you can get for the remainder of the move. Okay, and use some of the strategies and ideas I gave you in the trading plan and the entire model explanation and supplementary lessons. Okay, but you don't need to make this complicated. Know what you're looking for, bias, What's the narrative? Why should it go there? And how can you incorporate a entry strategy? This model uses optimal trade entry. Simple. If you combine the optimal trade entry and a fair value gap, you have what is, in my opinion, a very, very strong entry strategy. But notice we're not doing a whole lot of acrobatics. We're not trying to complicate it. We're not trying to add everything that's available in the mentorship. We're just using simple strategies at the right time, looking for them to fulfill based on the logic that is in concert with the narrative and commentaries I'm giving you on a weekly basis. So here is model number 3, delivering as you would expect it to, and stripped down, and much in the same way I've already done with the YouTube model. It's not a lot of things. It's not a lot of moving parts. It's very simple little strategy. You're looking for the market to pull back up into a range with the expectation it's eventually going to draw down to that old monthly low. And if you go back to the very first slide, if you compare the commitment traders data like this with the euro will communicate better with this hedging program application I teach with the CO2 data. It actually is a better read on predicting lower prices in euro. So you can look at doing the euro as a case study as well. And also make sure that you're blending with the expectations we had with the dollar index. And you'll see that this model is not hard. What's difficult is it's very difficult for me personally to hold on to a trade that long, because the entire time of holding that type of move where I allocate funds to a position, get short, and hold on to it and ride that out, I could be in 70 to 100 different trades and parlay that up quicker than just putting something in here and then worrying about this one, when my attention has obviously been, during the time of this recording, been in the stock index futures. But we've had moves in here, but the better moves, in my opinion, if I'm going to compare apples to oranges, it's been a lot more dynamic and explosive and predictable in stock index futures. So I kind of want to incorporate that here in case you refer back to it again in years from now, and that way you can see there's a reason why we were doing what we were doing. So hopefully you found this one insightful. Until next time, be safe.